We're going to highlight a couple of growth and income stocks now that have been performing rather well with our growth and income stock strategist, Todd Bunton. These are on your radar currently, the first one being Vectren Corp.
Yeah, they're a utility. They provide gas and or electric services to over 1 million customers in Indiana and Ohio. Founded in 1912, headquartered in Evansville, Indiana. Utilities have been interesting as a group. If you look, the best performing sector in the S&P 500 this year has been utilities. And there are a couple reasons for that. I'd say one of them is, kind of a flight to safety amid kind of an uncertain market, but also because if you look at interest rates, specifically longer-term interest rates, since the Fed started tapering, the 10-year yield has actually gone down, which a lot of people didn't expect. Yeah.
Wow.
So these higher yield utilities and REITs, which I'll talk about in a minute too. I also have brought a REIT with me, of course.
Why doesn't that surprise you?
Yeah, but those have been some of the best performing sectors in the entire market this year. And again, that's kind of because they got beaten down a lot last year. With interest rates rising in anticipation of the taper, but it's kind of bizarro world because now that the taper's here, interest rates have actually started to come down a little bit, and these stocks are rebounding. But Vectren in particular, I like. They've delivered 3 consecutive positive earnings surprises, very solid earnings momentum here, and management provided encouraging guidance for 2014. And that prompted analysts to revise their estimates meaningfully higher for both 2014 and 15. And that earnings momentum sent the stock to a Zacks rank of 2, which is a buy rating. And I brought with me the price and consensus chart for Vectren. And you can see a nice steady upward slope in consensus estimates for both this year and next year. If you look, the year-over-year growth projections based on these consensus estimates are pretty solid for utility. About 10% earnings growth projected this year, about 6% growth projected next year. And that's pretty solid, stable. It's not very tied to the overall economy. That's why people like utilities when there's uncertainty because of that stability. And of course, they also like them because of their yield. They pay a dividend that yields 3.6%.
There you go.
And Vectren themselves have increased their dividend for 54 consecutive years, which is absolutely phenomenal. Now, if you look at the rate of those increases, over the last 10 years, it's been about 2%, so it's really just pretty much kept pace with inflation. Their payout ratio is kind of on the higher end, so I'd expect going forward, maybe 1 to 2% dividend increases each year, but they're going to be increases nonetheless. If they've done it 54 years, I bet they do it 55 and 56, especially if they're growing earnings at a solid pace.
Never went broke taking a profit.
That's right. Yeah,
and it does represent profit to the investor.
Yes, it does. And if you look at the valuation, not a screaming value here. They trade about 17 times forward earnings, but there is some relative value within the industry. The industry median's about 19 times. So, a little bit of value there. Could be solid total return potential here in 2014. And for investors a little squeamish about the market, you've got safety here too.
All right, let's get to that REIT. Todd is the REIT master among the equity strategists here. Cousins Property.
Cousins Property, yeah. And just a quick blurb why I like REITs. On the income side, they have to pay out at least 90% of their earnings in the form of dividends to avoid paying tax on that money. So they always have solid dividend yields. And Cousins is no different. This REIT in particular is focused on office properties and primarily in the Sunbelt region, mostly in Houston, Atlanta, and Dallas, which are strong population growth markets and solid economies going on there. And if you look, about half of their portfolio is actually in the downtown central business district, but the other half's kind of in the suburbs, kind of in the outer ring of those bigger cities.
But they also have retail exposure. Is that a negative for them?
Retail itself, it kind of gets a bad rap because people, people assume that the mall's dying or brick and mortar's dying, but
and stories I've seen have been highlighting the fact that malls are being torn down.
Yeah, some of them, but there are. This is actually a really small percentage. They're almost predominantly office, so but
I think that's important to bring out for investors.
Yeah, retail's actually pretty pretty small part of their portfolio. But I have looked at, there are some retail-focused REITs, and those have been doing well too. They've been
Really?
seeing increases in occupancy rates and rents.
Interesting.
But so is Cousins. They've been seeing an increase in rents and occupancy rates as well. They've delivered 3 consecutive positive earnings surprises. And if you look at earnings estimates over the last 60 days, you can see a nice steady upward trend. And that sent it to a Zacks rank of 2, which is a buy rating. So very good earnings momentum here, and very good dividend, like I like to talk about.
Right.
So 2.6%
If I
yield.
had a bell here, I'd ring it.
Yeah. So about a 2.6% dividend yield. They did cut that during the Great Recession like a lot of REITs because, like I said, they pay out almost all of their earnings in the form of dividends. So if earnings decline, then you can expect that dividend to decline too. That is the extra risk you're taking on here. But they've been increasing it since then as the economy's improved and office buildings are filling up with businesses. So that falls to their bottom line. And if you look at the valuation, they trade about 16 times forward earnings. Historically, they've traded about 18 times. So there is a little bit of relative valuation here as well. Could be solid total return potential going forward. Again, this one is also interest rate sensitive. So if you're of the belief that interest rates are going to spike as the Fed continues to taper, then I would stay away from utilities and REITs. But so far, that hasn't been the case.
Okay, so take advantage while you can.
Yeah, absolutely.
Do you own either of these?
I do not.
All right. We have other stock picks and stock picking strategies on our website, Zacks.com. If you're watching this out in syndication land, get on over to the homepage and you can link to them right from there. With Todd, I'm Terry Ruffalo.